You've found the perfect house. Your offer is accepted, and now you have 30 days to close. Your realtor asks, "Who's your lender?" You panic. You talked to one person at your local bank, got a pre-approval letter, and figured that was that. But what if that decision, made in haste or out of convenience, just cost you $20,000 over the life of your loan? Or worse, what if your lender is notoriously slow, misses deadlines, and causes you to lose the house? Choosing a mortgage lender is one of the most consequential financial decisions in the home buying process. Yet most people spend more time researching a new TV. They go with whoever their realtor suggests or the first name that pops up in an ad. This is a monumental mistake. Your lender is not just a rate quote. They are your financial partner for the next 30 to 60 days of intense scrutiny and beyond. The right one is a guide. The wrong one is an anchor. Today, we're going to equip you with a systematic, step-by-step method to vet, compare, and choose the best mortgage lender for your specific situation. We'll move beyond the hype of lowest rate to the reality of total cost, reliability, and service. By the end, you'll know exactly who to talk to, what to ask, and how to spot the red flags that could save your transaction and your savings. First, let's understand the playing field. You have 4 main types of entities to consider, each with a different business model. The first is the big national bank. Think Chase, Wells Fargo, Bank of America. Their advantages are name recognition and the potential for relationship discounts if you have significant assets with them. Their disadvantages are often slower, more bureaucratic processes, less personalized service, and they may be less flexible with underwriting if your financial picture isn't perfectly vanilla. The second is the credit union. As member-owned nonprofits, they often offer very competitive rates and lower fees. Their underwriting can be more personalized, and their service is usually excellent. The downside: you must be eligible to join, and their technology and process might feel a bit slower or less streamlined than the big players. The third is the online-only lender like Better.com, Rocket Mortgage. Their strength is speed, convenience, and often very aggressive, competitive rates because they have lower overhead. The weakness can be a lack of personal touch. You might be handed off between different agents. And if you have a complex scenario or a tight timeline on a purchase, the lack of a dedicated local point of contact can be risky. They are fantastic for refinances. The fourth, and often most misunderstood, option is the mortgage broker. A broker is not a lender. They are an independent intermediary who shops your loan application with a panel of dozens, sometimes hundreds, of wholesale lenders. Their value proposition is choice and potentially better pricing, as they have access to wholesale rates that can be lower than what you get retail from a direct lender. A good broker acts as your personal shopper and advocate, finding the best loan program for your unique needs. They handle the communication with the underwriting lender. The potential downside is you need to vet the broker thoroughly, as their compensation is built into your loan, and you want to ensure they are placing you with a reputable, stable wholesale lender. In a purchase scenario, a skilled local broker can be a secret weapon, offering both great rates and white glove service. Now, let's get tactical. Your goal is to gather comparable data from at least 3 different sources, maybe a local credit union, an online lender, and a broker. You must do this within a focused shopping period of 14 to 30 days to minimize the impact of multiple credit inquiries on your score. They will be counted as one for mortgage purposes within this window. When you contact them, you are not just asking for a rate. You are interviewing them. Start with the loan officer. Ask, how long have you been in the business? Will I be working with you directly through closing, or will I be handed off to a processing team? What is your average time from contract to closing on a purchase in my area? Their answers will tell you about their experience and whether you lines have a single point of contact, a critical factor for peace of mind. The most important document in your shopping process is the loan estimate (LE). Once you provide basic information, income, assets, credit score, property address, and price, a lender is legally required to provide you with a loan estimate within 3 business days. This is a standardized 3-page form that makes comparing apples to apples possible. Do not accept a worksheet or a quote sheet as a substitute. Demand the official LE. You will compare 3 key pages. Page 1. Look at the loan terms. Is it a fixed or adjustable rate? What's the loan amount and interest rate? But crucially, look at the projected payments section. This shows your full PITI principal, interest, taxes, insurance, and any mortgage insurance. This is the real monthly cost. Page 2 is the gold mine, closing cost details. Here, you compare 2 main categories: loan costs, lender fees like origination, underwriting, application fees, and other costs, third-party fees like appraisal, title insurance, which should be similar across lenders. Focus on box origination charges. This is the lender's direct profit. A lender with a slightly higher interest rate but 0 origination fees might be a better deal than one with a low rate but $3,000 in points and fees. You must look at the total picture. This brings us to the single most important number for comparison, the annual percentage rate APR, found on page 3. The APR is not your interest rate. It is a broader measure of the total cost of your loan per year, expressed as a percentage, because it includes your interest rate plus most of the closing costs like origination fees, discount points rolled in. It is the best tool for comparing the true cost of loans from different lenders. If lender offers a 6.5% rate with high fees and lender B offers a 6.75% rate with no fees, lender B might have a lower APR, meaning it's the cheaper loan overall. However, remember the APR calculation assumes you will keep the loan for its full term. If you plan to sell or refinance in 5 to 7 years, a loan with lower fees and a slightly higher rate might be better even if its APR is a touch higher. Beyond the paper, assess the intangibles. Communication is everything. Does the loan officer respond to your emails or calls within a few hours, or does it take days? In a fast-moving purchase, you need a communicative partner. Ask about their underwriting timeline and whether they underwrite in-house or send it to a central office. In-house underwriting is often faster and more flexible. A major pro tip: ask your realtor for their experience. A good realtor has worked with dozens of lenders and knows who closes on time, who communicates well with agents, and who has dropped the ball in the past. This insider knowledge is invaluable. A red flag is any lender who is reluctant to put numbers in writing, who pressures you to lock a rate immediately with a today-only scare tactic, or who cannot clearly explain the fees on their loan estimate. In conclusion, choosing a mortgage lender is a due diligence exercise, not a popularity contest. Your process should be methodical. Identify candidates from different categories: bank, broker, credit union, interview the loan officers, obtain official loan estimates from your top 3, and compare the APRs and total closing costs. Prioritize a responsive communicator with a track record of on-time closings. The cheapest loan on paper is worthless if the lender can't close on time, causing you to lose your dream home and your earnest money. Your mortgage is a commodity, but the service delivering it is not. Invest the time upfront to choose a partner who is competent, transparent, and reliable. This decision will echo in your bank account for decades. If this framework gives you the confidence to shop smart, make sure you're subscribed. Next, WeLines examine a crucial external factor: how property prices themselves directly impact your ability to get approved. Now, go schedule those 3 lender interviews. Your future financial self will thank you.